Hey everyone, me Kevin here. Why does the Federal Reserve believe that there will not be massive and long-term inflation? Why does the Fed believe we can get away with printing 25% of the money that floats around in America or the world, because it happened across the world too, in fact worse in the world. We might be at a third of all the money that's circulating in the world was just printed in 2020, 25% printed in America in 2020. And another $1.9 trillion stimulus package getting deficit financed. Now we've got a big infrastructure plan coming up. How in the world is the Fed even remotely sane to say that they do not see inflation coming? In fact, here you go. Our forecast is for inflation to creep up to 2%, and our goal is to have it hit above 2%. This year, our forecast is around 2.1%, but we don't see it running out of control. That is a statement from the Fed today. Why? Are these people delusional? Are they just saying this because they're the ones cranking the shaft on the money printer? They're the ones going, brrr, like we better not see any inflation because then we're out of a job, then we're not gonna be money printing anymore. Or what's going on here? Why? Why does the Fed actually think there will not be inflation? Well, in this video, I'm going to break down 8 reasons in as simple as possible manner. So again, 8 reasons, 8. Why the Fed does not believe we are going to see long-term persistent inflation. And yes, that is designed to be contrasted with short-term inflation because yeah, in the short term, in other words, between let's say April and September, we're probably going to see some levels of short-term inflation that could run as high as 3 to 4% on a year-over-year comparison, especially as we compare to the pit of the pandemic and as we get back into a reopening environment where people are spending a little bit more freely just over excitement of trying to maybe go back to normal. We do not need more strains. We do not need another wave. Well, let's get into the 8 long-term reasons why the Fed doesn't think there's going to be inflation. Number 1, supply chain issues. Folks, by definition, supply chain issues in a capitalistic environment are temporary. That is, when we have a chip shortage or we have a ship stuck in the Suez Canal, these issues are temporary. Why are supply chain issues temporary? Because in a capitalistic global economy, when there's a shortage, prices tend to go up, but because of capitalism, more competition gets incentivized to enter. Even through higher barriers of entry, more competition is incentivized to get into a field, or individuals who are seeking certain supplies or companies seeking certain supplies look for alternative options or substitutes, and all of a sudden you reduce the need on those items or products or services that are having supply chain issues. And so hence, by definition, supply chain issues are temporary. The easiest way to think of this as is Suez Canal ship. Okay, ship stuck, things slow down. In the meantime, people who need stuff fast have to pay a little more to get that stuff fast. Everybody else just ends up paying with their time, their patience, they get delayed. Now, supply chain issues solve themselves in a capitalistic environment. As long as the reason for the issue goes away, which it tends to, whether it's a lack of current materials, fine, then more miners prop up. Whether it's a lack of employees in manufacturing facilities because a bunch were laid off and all of a sudden there's more demand than expected because COVID's over, fine, then factories hire more people. Supply chain issues, by definition, are temporary. And once supply chain issues go away, the odds of higher prices due to supply chain issues go away. So we do not expect the cost of shipping a 40-yard container to be $4,000 forever. We expect that to go back to the $1,500 it used to be. Maybe it'll go to $1,600, but it's not going to stay at $4,000 forever. At least that's, again, and I am projecting what I believe the Fed believes. The Fed speaks in tongue, so you kind of need somebody to interpret the Fed, right? But that's why you have me. And it's also why we have amazing programs on building your wealth linked down below, so I could give you my perspective on breaking things down and translating things in a way that actually is actionable and makes sense. Number 2, yes, asset prices go up and have been going up. Asset prices in stocks and real estate have been going through the moon, but you've also seen alternative assets go through the moon. NFTs, non-fungible tokens, Bitcoin, Ethereum, altcoins, they're all going to the moon, essentially. And they've all recently gone to the moon. And so there is an argument to be made that because of all the extra money printing, we are, yes, inflating asset values because there's more money available to be invested. So more money gets invested, driving these asset prices up. But an interesting thing about asset price inflation is that it's actually very distinctly different from consumer price inflation. And this isn't trying to reference the CPI, which stands for consumer price inflation. It's just to say that inflation, in terms of what we're looking for in the way of inflation, is, oh no, my diamond hand guy just became a lot more expensive. My TV became a lot more expensive. My $100 no longer buys 20 loaves of bread, it only buys 15 loaves of bread. I cannot buy as many coffees anymore because everything's gotten much more expensive, right? That's the type of inflation we're thinking of. Now, asset price inflation obviously does not change the price of my cup of coffee. If anything, it actually gives corporations more money when you have asset price inflation in stocks. It gives corporations more money, more access to capital, which actually lets them improve their efficiencies and potentially drive down the costs of 3D printing or shipping coffee because they have more money to innovate, and innovation drives prices down. So asset price inflation in general does not lead to consumer price inflation. Sure, there's the argument that, well, Kevin, what about the wealth effect? Yes, and this is fair. We're going to talk about the wealth effect, though, when we talk about the velocity of money, and that's for another argument. So for right now, solely and strictly, ignoring the wealth effect and ignoring the velocity of money, asset prices going up does not lead to consumer prices going up directly and permanently. Now that's important as well, because what happens when real estate prices go up? Well, more people demand housing. When more people demand housing, housing prices go up. And when housing prices go up, kind of like with the supply chain issues, when you have low supply, what happens? More people want to build homes. That's again, a perfect example of a capitalistic society. Is prices of something go up, it makes more sense to enter an industry and become a builder. It makes more sense to be a contractor or to be a contractor again and build houses for people. And so what happens now when there is temporarily a surge in demand for building homes? Well, now you have supply chain issues for not just the homes, but also for lumber, copper, sheet metal, concrete, everything, rebar, everything goes up. But that's directly linked to, yes, asset prices going up, but it's a supply chain issue, which again, by definition, a supply chain issue, temporary. So yeah, asset prices in that case can lead to temporary inflation. But that, again, temporary, not permanent. Okay, now, and by temporary, generally we mean 3 to 9 months. Under a year is generally deemed to be temporary. Okay, reason number 3, Kevin believes, the Fed believes there is no inflation that is going to permanently be a part of our society. Tech deflation. So, kind of like what I talked about with how if companies have more access to capital, they might be more likely or more capable of innovating. And when they innovate, they can 3D print faster, better, stronger. Kind of like the song. The same thing happens with technology. When our cell phones become much more powerful and all of a sudden we have 3 really incredible camera lenses that rival DSLRs, well, maybe now I don't need to buy a $1,000 DSLR anymore with 3 $3,000 lenses a piece, which means, 3 lenses, $3,000 a piece, plus let's say a $1,000 body. That's a $10,000 camera setup. Maybe I can replace all of that with an iPhone. Now, photographers, I understand, a lot of photographers are going to get pissed off hearing that. Don't get me wrong. I am filming on said $10,000 plus setup. Times 3 actually, since I got 3 angles over here. I get it. But the point is, even if 20% of people stop buying DSLRs because now they have incredible technology in their phone, that is an example of technology driving the reduction in demand for spending. Technology is making me have to spend less to get the quality of something that I desire, or even if it's 90% quality, technology is leading me to have a substitute to something very expensive. And that is an example of technologically driven deflation. As things become better and faster and stronger, we do not necessarily have to spend as much money. And the easiest example I could think of aside from this camera phone here is back when I sold my World of Warcraft account for $2,000, which technically you're not supposed to do, but I did many, many years ago. That makes me sound old. When I was 16 years old, which was 13 years ago, I used $2,000 to buy myself a Sony Bravia $2,000 TV. Yeah, it was really stupid. And when I go like this to make it seem big, it wasn't. It was like 40 inches. which was not that big for a TV, $2,000. Now I could spend $299 and probably get myself a 55-inch HD TV. Jeez. That is a perfect example of a technological deflation, right? Okay, let's move on from technological deflation because I think it's pretty obvious that technology leads prices to go down. Okay, now, number 4 is because we are in such a competitive global economy, increasing prices is sometimes very difficult for companies to do. Even though it sounds like, and it would seem logical that, oh, there's a shortage for chips, let's raise our chip prices. All raising chip prices does, and this is where you have to go to like from Econ 101 to like Econ like 102 or 103. Well, all raising prices does as a company is increase the incentives for competitors to compete against your business and try to take away from your business. When prices go up, more competitors come into a space, hence what we talked about with solving supply chain issues. So when there is a chip shortage, yes, chips sold on eBay and Amazon may go through the roof because they just don't exist. They're not available, and third-party sellers are reselling them for massive profits, and they're basically profiteering off these chips. But directly going to manufacturers, chip manufacturers, we tend to see lower price increases. We do see price increases, don't get me wrong. China has been raising the price of chips on us because there is a chip shortage. But companies tend to be reluctant to raise prices permanently and very high because it induces additional competition. Some price increases are expected, but again, those are temporary price increases. And companies like to stay competitive, so what they do is they, over time, drop their prices again to prevent incentivizing competitors from taking their business away. Going kind of back to that capitalistic argument, and this is one of the reasons why we actually see a lot of companies, when there are supply shortages, they end up eating the margin, that punishment basically, because there are supply chain issues, they have delays, so maybe they're able to deliver less products, and rather than raising prices and profiting more money, they take a little bit of a loss. Yes, I know this seems counterintuitive in business to actually take a little bit of a lower margin, but statistically, that is what companies tend to do. They take a little bit of a lower margin, and they just wait. We pay with our patience. And so price wars are not as common as they used to be in terms of, oh, they're raising their prices, okay, let's raise our prices over here. And that's because of the competitiveness of our global economy. We're more likely to pay with our time than we are for a higher priced product. It's crazy. And look, there are examples all day long of prices going sky high on Amazon. We got to separate ourselves from retailers ripping us off and actual wholesale prices of some of these products. Chips and video game graphic cards being a perfect example of don't compare to Amazon to try to see inflation. That's not the right way to do it. Okay, then the other thing is when we have bond shorts happening like crazy because people expect inflation to come like crazy, we end up having the potential, and this is crazy, but we end up having the potential for a short squeeze in bonds. This could be insane. So think about this for a moment, because this is a total head trip. When people believe that inflation is coming, they sell bonds. When bonds sell, their price goes down. There's more supply of bonds because people are selling, price goes down. When price goes down, yield goes up. But all of a sudden, when yield goes up to a certain point, you hit this sort of bell, ding, you hit this little bell, and all of a sudden you're like a beacon for the global economy to look at you and go, oh, damn, I could get 2% risk-free money in America, and I get 0% for a bond in the European Union, or worse, I have to pay. So I buy a bond, I'm supposed to get paid interest, but no, I'm paying money? Negative yields on bonds? Yeah, that's what you're getting in Europe. So European bond buyers, or even Japanese bond buyers are like, that US dollar, if I could get 2% risk-free on a US bond, I might take that. So at some point, you could actually create a bond short squeeze. So you've got people selling off bonds like crazy. which when people sell off bonds like crazy, the price of bonds falls, which leads people to say, oh, we might see bonds sell off even further. Let's short bonds. And the price falls even more. The yield goes up even more. Then, boom, ding, you hit this high level. Maybe that's like 10-year 2%, right? 10-year Treasury 2%. We're at like 1.76% right now. And then what happens? Ding, you hit the bell. All of a sudden, foreign investors, oh, wow, this is amazing. Buy US bonds. All of a sudden, US bond yields go down because you have this new demand. Prices come up. When prices go up, there's a possibility of creating a bond short squeeze, which actually means the bond buyers or the bond shorters might have to cover, driving up bond prices even more, driving yields down even more. So yeah, you could literally set up a bond short squeeze because of this latest drama that we're seeing about maybe inflation coming. These are things to keep in mind. Bonus, by the way, remember how we were talking about price wars? I just want to add this note about the last argument here. Remember how we're talking about price wars with price shortages? A lot of folks believe that, hey, well, I mean, energy costs are going to go up. Like, there's no way when we reopen, oil is not going to go through the roof, and then gas prices are going to go up, and everything's going to get a lot more expensive. Well, here's the beautiful thing about America and the hyper-competitive environment that we're in. Back in 2009, yeah, energy prices went up. We had big issues. They went up substantially. I mean, we were talking like $5.50 per gallon of gas in California. It was absolutely nuts, right? But what happened between 2009 and now, 2021? Well, fracking became really popular. Now, fracking only makes sense at a certain dollar cost per barrel of oil. Below a certain price, companies are better off shutting down fracking facilities and just, or drilling facilities and just not drilling, which sounds crazy, but it's true. Now, if oil prices go up and we get this COVID economy reopening again and there's more demand, sure, OPEC could try to hoard oil and go, don't sell. We don't want to flood the prices or flood the market and drop prices. That's a manipulation, right? OPEC manipulates the prices of oil by kind of keeping their product embargoed. Oh, no, we're not selling as much of this. Fine, but enter the United States fracking competitiveness, which, yes, Biden has limited on federal lands, but on non-federal lands, fracking is still more than possible. What happens? Well, energy costs go down again when all of a sudden you have more local suppliers opening up their drilling wells and fracking facilities again. And that tends to drive down the price of energy costs again. It's that price competitiveness. Even though it seems like, well, but Kevin, I mean, come on, if the price of gas goes up to $3, why wouldn't I just sell the gas for $3 all the time? Why would I drop it to $2.50? Because when the gas station across the street sells it for $2.50, you're not getting any business. Hence, competition, right? It's interesting. Now, again, we don't have to believe this, but I'm just making the argument here on behalf of the Fed. Okay. Next, reason number six, the Federal Reserve doesn't believe that we'll actually see inflation. And yeah, I mean, if you think about it, take a break for a moment. We've already gone through 5 reasons why the Fed doesn't actually believe we'll see inflation. Do you believe it so far? Think about it for a moment. Ask yourself that. Do you believe we won't see inflation? Well, quick little recap. Supply chain issues, temporary. Asset prices go up to create temporary supply chain issues, but don't really affect long-term inflation. Tech deflation, remember the TV example. Price war, remember the competitiveness. Gas, oil. Bond shorts, the potential for a massive bond short squeeze. Foreign buyers coming in, buying our bonds as they become more attractive while Europe flounders with negative yielding bonds. Come on, our bonds can't go up that high when you've got negative yielding bonds in the Eurozone. It's crazy. Then you got number 6, the mature economy argument. If we look at mature democracies throughout the world, historically we find that the same thing is true over and over again. Mature democracies do not experience hyperinflation or high inflation. Now, in the 1970s, when the United States left the gold standard, this was different. The United States left the gold standard to go to fiat, a completely new concept for the United States. This was not an example of a mature democracy with a mature monetary system. This was an example of an infant monetary system that people now had to trust rather than know that it's backed by gold. Now that trust has established itself at least somewhat. I mean, I know many of us watching this video are like, Kevin, I don't trust the freaking government, but I mean, relatively, you probably trust the American dollar more than you trust other currencies throughout the world. I'm not going to pick country names here, but I think if you would rank, like if you had to take your entire net worth right now, and you can't pick cryptocurrency, okay? You had to take your entire net worth right now. What do you want to put it in? The yen, the peso, the yuan, the euro, the dollar, the Canadian dollar? What do you want to put it in? The United States, relatively, might be up there with these other ones. It could be number one out of all of these other ones. Do you want to put it in Zimbabwe's currency? Do you want to put it in, certain South American countries' currencies that are very developing countries? Do you want to put it into India's currency, where all of a sudden, what was it, a few years ago, they're like, that's it. Everybody bring your money, prove where you got your money from, and then we'll let you keep or exchange your old money for a new currency. Do you want to deal with that? So that relative mature economy argument is very, very important. You got to look at the economies and decide, yes, the United States has a relatively mature economy now, especially after the 70s. Do we expect that to happen again? Well, I mean, for the other 7 reasons in this video, probably not. But certainly, when we look at history and we look at mature economies, and specifically democracies, we tend to see deflation more than we see inflation. That is, or I should say disinflation. We see inflation trending down over time. That's what we tend to see. Just is what it is. Number 7, the failure of the Phillips curve. So the Phillips curve is just a fancy, complicated economist way of saying, hey, look, when unemployment gets really low, people are going to, or companies will find it harder to find workers. And when companies find it harder to find workers, they're going to have to offer their workers more money to get workers. And because of that, they'll drive prices for workers up. And if the prices for workers go up, then the input costs at companies will go up, and we'll have inflation, because when input costs go up and the price via the price of workers going up, then the end product might get more expensive, and boom, there you go, consumer price inflation. Unfortunately, that has broken apart. That has not been true in all of the past 13 years. Now, it could come back. The Phillips curve could actually work again, but right now it doesn't work. We've had some highly declining and very, very low unemployment in the United States over the last, certainly we had a nice strong downtrend over the last 13 years, 12 years leading up to the pandemic. We didn't see inflation. We didn't see that relationship between workers getting paid more because there was low employment and inflation. We didn't see it. And this is leading some economists to say that these long-term trends for inflation have changed. And the Phillips curve might be broken. Maybe that theory doesn't work anymore. After all, economics is all about theories and the way human psychology works when it relates to money in aggregate. And humans are really different. We're not like robots. We're very difficult to predict, so nobody knows. But this is an issue. Then you have reason number 8. Why the Fed doesn't see inflation happening, at least right now. The velocity of money. Sure, we've seen money printing and the M2 money supply go through the roof. It's straight up and to the right, substantially up. Up 25%, it's going to go up even more this year. Velocity of money has plummeted from about 1.4 times circulation. This $100 used to circulate 1.4 times. When I deposit in my bank account, it might circulate 1.4 times. I go outside and spend it, maybe it'll circulate 4 or 5 times before it ends up, wherever it ends up. But the velocity of money, at least according to the M2 velocity of money, has plummeted. It's gone from 1.4 times circulation to about 0.9 times circulation. Now, there are a few possible reasons for this. One is people are saving more and they're taking this money and they're investing it. So they're either saving it or they're investing it into stocks or real estate or Bitcoin or NFTs or other altcoins, whatever. But the point is, we haven't seen a return to the velocity of money yet. Now, this is probably the biggest argument for inflation right here, number 8. And that is that the velocity of money could return. And this is why it's actually very important, out of all these reasons, to probably pay attention to the velocity of money chart. You can Google this. St. Louis Fred, F-R-E-D, M2 money supply. Just watch the chart. If this goes back to 1.4, with the amount of money that has been printed, probably have issues. We could probably see pretty quick inflation, dramatically, probably for a short term. So it would create a whole lot of imbalance, and that would repair itself over a few painful years. So that is a risk factor. That is very much a risk factor. However, an argument now is that the velocity of money may never return to the levels of where it was before, because maybe a lot of that money did flow to wealthier households who are investing it. Wealthier households maybe only need so many boats and so many yachts and so many airplanes and so many watches. And if that's true, if the K-shaped recovery is true, that the rich got way richer and the poor did not, then maybe that money won't make it back to the economy. Maybe a lot of that velocity of money, maybe all that money printing did just make rich people a bunch richer, which is very depressing for anybody who wasn't a beneficiary of that, which is probably 90% of people, unfortunately. The reality is, if the velocity of money does not go up, we have a very good chance of not seeing inflation, which is also kind of scary because it's like, wait a minute. That literally means we were able to get away with all of that money printing and we didn't see inflation. It's official. The game is rigged. And yeah, I agree with you. The game is rigged, which is exactly why I encourage you to learn how to take advantage of the game the way it's played in my courses on building wealth, linked down below. Folks, I thank you so much for watching this. Let me know what your thoughts are, and we'll see you in the next one.